Time for the latest earnings outlook now with Research Director Shiraz Mian. We're going to try and put this fourth quarter earnings season into perspective for you now. Shiraz Mian's been kind enough to drop by the old video ranch here and help us do just that. So not many more companies left to report for 4Q. It was not great, but it was not ugly either. Give us a quick assessment here as we wrap it up.
I think you put it correctly. It wasn't ugly as some folks out there were expecting it, but it wasn't good either. In fact, based on a lot of metrics on which we measure the quality of an earnings season, it fell short of expectations on a number of them. The growth rate turned out to be a tad better than what we were expecting preseason. The number of companies beating was lower than what we have seen in this cycle. And also the extent of the beats were quite minuscule. In fact, the lowest that we have seen in this last 8-9 quarter old earnings cycle. And we had the first negative quarter-over-quarter decline from the third quarter to the fourth quarter. So yes, it wasn't extremely bad. But there's not much to write home about.
So are we going to see this continue now as we look forward to Q1?
I would think so. I think those double-digit growth rates that we got accustomed to over the last 7-8 quarters is a thing of the past now. We should get more used to mid to high single-digit growth rates, maybe even lower. I would expect even the Q1 growth rate to be a tad lower than what we saw on a year-over-year basis in Q4. And even in Q4, if you strip out a few of these standout performers like Apple, Caterpillar, and Boeing, the growth rate was not that impressive. So yes, it's a new trend that we should get used to on the earnings side. Lower growth rates on earnings, lower growth rates on the top line, and fairly flat margins.
Is this a trend that concerns you, or is this a move back to more normalcy?
This is normalcy. As I mentioned, we have been through about 8-9 quarters in this earnings cycle now. Most of the easier gains have now been achieved. Earlier on, the gains were through margin expansion. That is over. Then we had some very nice top-line gains, but revenue growth pretty much point-to-point tracks the nominal GDP growth rate in the U.S. and on the global basis, and we are seeing some deceleration on the GDP growth rate globally as well. So you will have some contraction on the top-line front. Margins, as I mentioned, are gone, and that brings you into the more normalized earnings growth territory of middle single-digit growth rates on a year-over-year basis and the occasional negative growth rates on a sequential basis. I'm not terribly concerned about it, but it is a headwind for the market. Okay. We don't have that positive driver that was pushing stocks higher anymore, and if other positives do not emerge, then it could be a problem for the market.
All right, you mentioned standouts a moment ago. Give us a couple of standouts that you see for Q1.
You know, we saw some reversal in the estimate revisions over the last 4 to 6 weeks. Industrials have come back. We are seeing positive revisions there. Technology, transportation is good. Construction is good. So these 3-4 sectors will likely do quite good in Q1. But the broader story, as I mentioned earlier, in Q1 would be essentially a replica of what we saw in Q4.
Okay. You can get Shiraz's comments on the market, the economy, earnings, corporate situation as he sees it, and much more in a daily column that he writes on Zacks.com called Ahead of Wall Street. Check it out. With Shiraz Mian, I'm Terry Ruffalo.